Hello everybody, in this video we'll be starting with the chapter number 7, Moving Averages of CMT Level 1. Before watching this video, make sure that you have watched the previous chapters. In case you haven't watched them yet, I've linked it in the description box below. So in this chapter, we'll be learning about what a moving average really is. If you are a trader or if you've been into the markets from a while, you will already be familiar with what are moving averages, because moving average is one of the first indicator which a trader is usually introduced to. So what are moving averages actually? If you go to your charts, let me just put a moving average. Okay, look at this. I've already put a moving average, but I'll still show it to you. So I'm going on indicator and I'm just searching moving average. Give me a sec. Moving average. Okay. So when I click on moving average, a line like this gets plotted on your graph. So you can see that the line is basically following your price. Wherever your price is going, the line is also going there. So moving averages can also be of different lengths. So for example, right now, don't get confused, we'll go into the detail. You can see 9. So the length of the moving average right now is 9. So if I want to change to, let's say 200, since 200 is the king moving average, 200 moving average is usually known as the king moving average, right? So if I plot my 200 moving average, you can see that it is showing you the broad trend. This is basically showing you your long-term trend, like how your trend is in the long term, in the long picture, right? So this is what is a moving average. Moving average is basically a line like this which is plotted on your graph also. Before that, let's just continue the PPT and I'll explain. Okay, so what is the purpose of moving average in the first place? So the moving averages smooth out the smaller fluctuations. If you look at the candlestick chart, only the candlestick chart, you can see that many fluctuations are also visible in your price chart. But when you use a moving average, most of these tiny fluctuations are smoothed out. So hence it gives you a clearer picture, a better picture before you trade, right? And obviously, as I have explained before, moving average is the most common tool and it is used by almost every trader, no matter how small or how big. Let me just check in the book if there is something which I have not discussed so far. Alright, so moving average is one of the oldest tools used by technical analysts, and technical analysts use the moving averages to smooth erratic data. So when you smoothen the erratic data, it makes it easy for you to view the true underlying trend. Alright, so we know that also. The principal reason that moving averages are used is to smooth out shorter fluctuations and focus on the trend that fits with the investor's time horizon. So now we are going to see the actual true underlying trend. So by looking visually, by looking at the moving average, you can see how the trend is going on, right? And the length, what do you understand by length of a moving average? Depends on the number of bars you want. We'll come to that. Alright. So now we come to the first step of moving average, which is a simple moving average. So simple moving average is something which every beginner must use before going into the other types of moving averages, right? So what is a simple moving average? So how is a moving average calculated in the first place? Let's talk about that. It takes the closing price of all the previous days and takes the average of it. And when you take an average of the previous closing price, a line is generated. That is how you calculate a moving average. Even though you don't have to go into the detail of what calculation it is very essential for you to know. So simple moving average is basically also known as the arithmetic moving average. Why is it known as the arithmetic moving average? I just discussed that a simple moving average is the mean of the closing prices of the previous candles, right? So mean, arithmetic mean. So that is why it is also known as the arithmetic moving average, and it can be used in different periods. Okay, so we are using closing prices. Whenever you are calculating a moving average which is simple in nature, you are using the closing prices, right? So that is how you are going to calculate. you are going to take an average of the previous days. Now let me go into the chart and show you a practical example of what I'm trying to explain. Now look at this. This is a 200 moving average, right? So this point, wait, this point over here is basically the mean of the previous 200 days candle. Okay, if it's a daily chart, let me just take a daily chart, right? So this point is basically the mean of the previous 200 candles. This point is the mean of the previous from here. So like that, every day whenever the line extends and the line grows forward, you can say that it is the mean of the previous 200 days. So that is what is known as my simple moving average. So as in when a next candle gets formed, the first candle is not there anymore, right? So it is a 200 moving average. So this shows the 200 day moving average. Why am I saying 200 day moving average? Because I'm using a daily chart, and the previous 200 candles will always show me my previous 200 days. Now if I change my time frame to, let's say, 15, it's a 15-minute chart, right? So if I'm talking about if I'm talking about my 15-minute chart, then what happens? The 200 moving average shows me the previous 200 candles. So it will not necessarily always be 200 days. It is always the number of candles. So it depends on what time frame you are using. So if I'm using a 15-minute chart, I can say that my 200 moving average will be showing an average of my previous 200 candles, right? Previous 200 15-minute candles. So if I say, let's say I open a weekly chart, in that case my 200 moving average will show me the I will be showing the mean or the arithmetic mean of my previous 200 weeks or my previous 200 candles, right? Now why am I emphasizing on 200 over and over again? Because if you look here, the length of my moving average is 200 right here, but it's up to me whether I want my length of the moving average to be 200 or something else. So that is something we will be looking at forward, but I'll show you something. If I want to change the length to, let's say, 50, in that case what happens? Look at this, the moving average changed its shape. In this case, since it is my 50 moving average, my moving average shows my average of the previous 50 candles instead of my 200 candles, right? And now it shows previous 50 candles. So the length basically takes into account the number of candles used to calculate my average. I hope that is clear. So that is my simple moving average. Alright, and it is also known as an arithmetic moving average. Even though usually you shouldn't be tested on how to calculate the moving average, but I'll still just explain something. So right now we saw what is a simple moving average, right? So if let's say my length of my moving average is 10, then I will add the closing price of the previous 10 days. So these are my closing prices of my previous 10 days divided by my number of observations 10. This will give me my point in the moving average. Alright. So this is what is known as my simple moving average. You basically are just calculating the arithmetic mean, which is not that big of a deal. Okay. I hope you understood how to calculate this. That is how my simple moving average is calculated. Alright, moving on to the length of moving average. Now length of moving average is something which I have already discussed, right? You know how you can choose the length of a moving average. The length of a moving average will basically show you how many candles are being considered in order to plot the moving average. Where I say that I'm using a 200 moving average, that means the length of my moving average is 200. If I'm using let's say 10 moving average, in that case my length of moving average is going to be 10. So like that you can use whatever length you want to. Pause the video over here, open your trading portal, open your trading view, and try to change the length of your moving average and try to observe what you see, because that's how you're going to learn. Okay, so that is what is my length of moving average. Okay, now If you think about it, the length of moving average, tell me something logically. If I'm using a 13-day moving average and a 26-day moving average, which one is going to give me a early signal? Think about it. A 13-day moving average is a shorter time moving average, right? So a shorter time frame one is going to be the most recent moving average. So that would give me a quicker response, or that would give me a quicker indication. Whereas my 26-day moving average is something which is larger than my 13-day moving average. So in that case, that one will give me a late indication, right? So that's how you are going to mix and match, and you'll be using two types of moving average. That also we'll be seeing later. Okay. Alright, now we come to the new concept, which is multiple moving averages. So as I had mentioned, you must have heard of words like the golden cross and stuff like that. So what are those? Those are basically a system generated using the moving average, wherein you are using two moving averages, or you are using dual moving averages in order to generate a signal. So how do people do that? They usually have a combination of two moving averages. One is going to be of a shorter time frame, and one is going to be of a longer time frame. For example, the 13 and 26 I told you, and people also use 50 and 200, right? So that you can backtest and check for yourself and see which suits better. But I will show you a little bit of practical example. Let me go to Nifty only. Nifty 50. Okay, I'm removing my support resistance. Just a second. Okay, look at this. So right now the black line is my 50 moving average. Let me add one more moving average. Let me add 200. Okay, I'm going on my settings and changing the length to 200. I hope that is clear now. So blue is my 200 moving average in this case. Okay, so look at this now. The black one is my 50 moving average. The blue one is my 200-day moving average. So how can I use it in my trading? Just an example. First of all, if you can see that your black line is also rising and your blue line is also rising, that gives you a double confirmation that the larger trend is also an uptrend and the smaller trend is also an uptrend, right? So if you look at this over here, where your blue line is rising but your black line is coming down, that shows you that your larger trend is rising but your short term trend is falling. So that is a sort of divergence. So you can avoid trading in such situations. So you can always use two moving averages, one of the larger time frame and one of a smaller time frame, and you can use that in order to confirm your trend and before you basically take a trend. Okay, all right. Now what happens when a smaller time frame cuts your larger time frame? Let's see that. Look at this. If you see, the black line basically cut your longer time frame. So from here the market fell a couple of points. Let me just go to a daily chart, it will be clearer for you. Okay, look at this now. All right, so blue is my shorter time frame, right? No. See, I always get confused. I'm making 200 black and I'm making 50 blue, because according for me, whenever I mark a black color moving average, it's always a 200-day moving average. Okay, because whenever every time I see a blue color, a black color line on my chart, I know for a fact that it is my 200-day moving average. So now the blue one is a 50-day moving average and the black one is my 200-day. Okay, so if you look at this cross over here, my 50 moving average cut my 200-day moving average from down to up. What happened after that? If you can see, after that, after this signal, my price pumped up till God knows where. Look at this, how much it pumped up, right? So whenever a small moving average cuts the primary trend or cuts the larger moving average, then you can expect a big move to come over there. Again, look at this over here. A smaller moving average, which is my 50 moving average, cut my 200 moving average towards the down. In that case, what happened? Look at this. My price pumped till here. Okay, understood? So that is how you can use two moving averages or dual moving averages. Okay, so you can use your whenever where the shorter moving average crosses above the longer, uh, is often taken as a mechanical buy signal, or at least a sign that the price trend is upward. Alright, so whenever a smaller moving average crosses your bigger moving average, you are supposed to take a trade which is towards the smaller moving average. So that is what is known as a crossover signals. So when somebody mentions what are crossover signals are when two moving averages are crossing over with one another. Hope that's clear now. Let's go to the next topic, LWMA. So this is the linearly weighted moving average. So before this we saw what a simple moving average is, right? A simple moving average, and we saw how to calculate a simple moving average. It is just plain basic mean or plain basic average, right? Now we are going to start with the linearly weighted moving average, the LWMA. So what is the linearly weighted moving average? Let's think about that for a second. So in the linearly weighted moving average, the recent data is given twice importance. So whatever data is of my recent dates, that data is given twice importance. But what is the drawback of the linearly weighted moving average? The linearly weighted moving average drops the early data. The early data is given zero importance, it completely drops it, right? So that is the drawback of it. So I hope you understood what I am saying, that whenever you're using the linearly weighted moving average, the recent data is always given twice the importance, and the earlier data, the initial days data, that is something which is eliminated, omitted and dropped. So that is not at all taken into consideration. Okay, let's go and check on the charts. Look at this. This is my linear weighted moving average. Okay, look at this. How the moving average is just kind of sticking on my price. It is exactly where my price is. So why does this happen? This is because it is it's not giving importance to the early data, right? And it is giving 2 times importance to the recent data. Since it is giving twice importance to the recent data, it is sticking to the recent price. That is why it is sticking to the price right now. So this is what is my linearly weighted moving average. I hope that is clear. Okay, now we come to EMA. So EMA is something which most of the traders use again, but I would suggest that start with start with a simple moving average, and then you can go to an exponentially moving average. So if you look at the EMA, the exponentially smoothed moving average, what do you understand by the word exponentially, and how is this better than the linearly weighted moving average? If you can recall what we learned in the linearly weighted moving average, and if you can recall the drawback which we had, it was that it used to drop the early prices, right? It used to completely drop the early prices. But when you are using EMA or the exponentially smoothed moving average, the dropping the early data is not happening over here. It doesn't drop the early data. More recent prices are weighted more, but it doesn't disregard the early prices. So in exponentially moving average, in this system, what happens in this moving average, it does give more importance to the recent data. Just like the linearly weighted method, it actually does give more importance to the it gives more importance to the recent prices, but at the same time it does not omit, or it does not cancel out, or it does not disregard the early prices. It gives less importance, but it does give importance to the early prices as well. Clear? I hope you understood the difference between linearly weighted and EMA. In the linearly weighted, what used to happen is that the recent data is given twice the importance, but the early data was completely omitted. But when you are talking about EMA, the recent data is given more importance, but the early data is given less importance, but it is not omitted at all. Okay, that is what is my EMA. If you want, we can plot it and we can check that out for you. EMA, moving average exponential. Look at this. It is not sticking to the price, it is a little bit away. Why? Because in EMA, I know I'm repeating it over and over again, but it might be tested in your exam. Here what happens is that it is tested and it gives more importance to the recent data, but at the same time it also in a way doesn't omit or doesn't disregard the previous prices. Okay, now we come to the next thing, which is my geometric moving average. So geometric moving average is usually used only in the indexes, right? Why? Because in indexes you have data which is over 200 years, 300 years, 400 years. So the amount of data which is available in indexes is very huge, right? So the GMA or the geometric moving average is something which is usually used in indexes only. Let me see what's written in the book and if I've missed anything. Okay, so the geometric moving average is mostly used in indexes. It is a simple moving average of the percentage changes between the previous bar and the current bar over some past predetermined period. Using percentages rather than points does not change its range or dimensions like price based moving average. However, it has other problems of equal weight and lag. Okay, so what really happens in a GMA is that instead of calculating the average on point basis, we use the point or the price basis, right? Until now, in index we use the percentage basis. So the GMA basically takes in account the percentages, and it constructs a simple moving average of the percentage change of the previous bar to the current bar. That's about it about our GMA. This is all you need to remember in GMA. Okay, now we come to triangular moving averages. So triangular moving average in a literal sense or in simple sense is basically constructing a simple moving average of a simple moving average. So first, how do you construct a moving average? From the closing prices of the candles, right? So a moving average is constructed like that, and then you again construct a moving average of the moving average, and then you get another moving average. So that is what is known as the triangular moving average. So taking a moving average of a moving average gives a doubly smoothed moving average. Just a second. Okay, it gives a doubly smoothed moving average, right? So TMA begins with a simple moving average of a predetermined number of bars, and then using those results takes a moving average of a length of a half of the original number of bars. Alright, I hope you understood. So an example would be a 20-day SMA of daily closes smoother than a 10-day SMA. So first you calculate a moving average of the entire period, and then you calculate the half the moving average of the moving average which you have calculated. When you do that, you get a smoothed moving average. So this is what is known as my triangular moving average. Okay. So until now, what are all the moving averages which we learned? We saw what a simple moving average is. We saw what a linearly weighted moving average is. We saw what exponentially moving averages. We saw what a GMA or a geometric moving average is. And now we just saw what a triangular moving average is. Okay. Now we come to what is a variable EMA. Now we come to the next concept, which is of variable EMAs. What do you understand by variable EMAs? The use of a variable moving average is suggested by Shander and Kroll. This moving average is same as the EMA, but the weighted scheme is adjusted based on the volatility of the price data. This is done to make the EMA shorter during trading ranges when volatility is narrow, and expand the EMA when prices begin to trend. The desire was to reduce the number of adverse signals during the trading range. I don't know if you understood what I just read out, but basically variable EMA is when you also take into account the volatility. So when the volatility is more, you will be getting correct signals, but when the volatility is less and when the range is really small, in that situations what really happens is that you might be getting false signals as well. So that is what they are basically saying. So this is my variable EMA. Okay, now we have something which is known as a Mama Pharma strategy. So what is a Mama Pharma strategy? Think about that. Alright. Mama, the MESA adaptive moving average, and Pharma, the following adaptive moving average. So MAMA is basically the MESA adaptive moving average, and the FAMA is the following adaptive moving average. So these are EMAs that adopt to volatility. Okay. Needless to say, the calculation of this moving average is complicated. A buy or sell signal is generated when the MAMA crosses the FAMA. So whenever the MAMA crosses the FAMA, then a buy signal is generated. Don't go into the detail of it, you just need to have the basic idea of the same. Okay. So you know what a MAMA FAMA strategy is. When a MAMA crosses FAMA, then you are getting a buy signal. That's it. Moving on to a strategy. Okay, now we come to the most important practical concept in the chapter, which is what are the strategies which we can use for moving averages. So what are the strategies which we are supposed to use for moving averages? So the first strategy is basically determining the trend. So I've already discussed this couple of times, but when you actually are when you look at a chart with a moving average, you can already determine the trend which is going on in the prices. As soon as you look at the chart, you know what is the trend which is going on, or what is the you can determine what trend is going on, right? So that is what is known as determining the trend. The moment you put a moving average on a chart, and when you just look at it visually, you already know, is it an uptrend, is it a downtrend, or is it a side trend. For example, let's go to my chart and let me um, not use exponentially moving average. I'm just using a simple moving average because I personally use a simple moving average. Let me go to a 50 moving average. Okay, let me go to a 20, no, let me go to 50 moving average. Okay, now look at this. Here, in this period, you know that the price is going up. Without even looking at the price, you can just look at the moving average and you can easily say that the price is going up. Now look at this zone over here. In this zone, the moving average line is basically falling. So by looking at it, you can visually say that the prices are falling. Even without looking at the price and everything, you can just look at the line and you can determine the trend. That is what is known as determining the trend. Okay. So technical analysts use moving averages in four basic ways. The first thing is that the moving average are used as a measure of trend. The most common usage is comparing the current price with the moving average that represents the investor's time horizon. For example, many investors use 200-day moving average. If the stock or market average is above its 200-day moving average, then the trend is considered upwards. Conversely, if a stock or market average is below 200-day, it is said that it is considered downward. So this is a common notion which is used by many investors, that whenever the price of a stock is above the 200-day moving average, it is considered to be in an uptrend, and whenever the price of a stock is below the 200-day moving average, then it is considered that the stock is in a downtrend. So this is just one way of determining a trend using a moving average, right? Okay. So the second strategy you can use in order to, let's say, find in another strategy in order to use the moving average is support resistance. We already know what support and resistance are. We saw it in the previous chapter, and sometimes the moving averages work as support and resistance. Like for example, we were just talking about the 200-day moving average. Usually a 200-day moving average acts as a great support or resistance. Again, don't take my words rigidly. There can be places where it doesn't work, since nothing in the market is ever 100%. So backtest and use your own brains before you get into a trade. But moving averages also act as a support or a resistance, right? So moving average often duplicates the trend line. Therefore, it can be an easy trailing stop mechanism in determining when a position should be liquidated. Now let me go into the chart and show you an example of what I'm trying to explain. This is my trading view chart again, and my moving average which I'm using, let's say I'm using a, okay, I'll go on a stock. Okay, I'm going on my Reliance. This is my daily moving average, and I'm using a 44 moving average. Now why am I using that? Because it seems to work really well as a support or a resistance. That's why I'm using this. Now look at this. The moving average is falling, falling, falling. My price came and made a red candle over here, resisted this. So it took resistance on the moving average. Now what happened after that? My price pumped down. Understood? My moving average is falling, my price rose, came here, took resistance over here at the moving average, and then it dumped and fell down again. So that is how the moving average sometimes works as a support or a resistance. Now again, look at this. I'll show you more examples. Okay, here my moving average is basically rising, right? It's rising. Here my moving average took a support here, and then the price went a little bit up again. So when the price is falling, you should look for shorting trades. When the moving average is falling, you should look for shorting trades, and when the moving average is rising, in that cases you should look for a buying trade. If you look at this, so avoid trading in a sideways. Okay. So you can see that the market is in a clear uptrend, right? It's in a clear uptrend. So here in this candle, when the price took support, if you have bought over here, easily 1:2 would have been achieved. Okay. Now here my market is falling, my moving average is falling, so it took resistance over here and it pumped down. So that is how you can say that the moving average can act as a support or resistance. Okay. Alright, so the third strategy which you can apply using the moving average is determining price extremes. So what do you understand by price extremes? So this is something which has been back tested by many of the people, and something which is very commonly observed is that price has a tendency to return to the mean. So if usually if you go on the charts and if you see, whenever the moving average is very far, whenever the price is very far away from the moving average, it usually comes back to the moving average. So price usually has a tendency, like a magnet, it always comes back to the moving average or the mean. So the price has a tendency to come back to its mean very often. Some of the people call this the magnet strategy, wherein whenever they see that the price has gone really far away from the moving average, then as soon as they see a bearish candle, they enter into the trade because they are sure that the price will come back to the moving average. Okay, that is what is known as determining the price extremes. So the moving average is an indicator of price extremes. Because the moving average is a mean, any reversion to the mean will tend to approach the moving average. For trading purposes, the reversion is sometimes profitable when the current price has deviated substantially from the mean or moving average. So when the price is when the price has basically deviated way too much, it usually comes back to the mean. Okay. Trading against the trend is dangerous and requires close stop losses, but the reversion also provides an opportunity to position when the trend occurs. An example of a deviation about a 10-day SMA is shown in the figure. Alright, so in the book they have given you examples of the determining the price extremes, so that I will show you in the chart only. Okay, so now I am using the 44 moving average only. Let me go and use a 50 moving average. Let me use a 60 moving average. Okay, if you look at this, the moving average is over here and the price is over here. So if the price is over here, it will usually come back because it is so far from the moving average, right? If you look at this, it is so far from the moving average. So from here what happened? The price came back to the moving average. Now again at this point, moving average, the price is really far from the moving average. In this case, it is the price will be coming back to the moving average, and look at what happened. The price came back to the moving average. Again here, the price is really far from moving average. So if you see, the price came and touched the moving average again. So whenever look at this, the price is really far from the moving average, it came back to the moving average. In fact, it went even down, and it works the same way in the downside also. The price is really far from the moving average, so it came back up and touched the moving average. So look at this again. The price is far from the moving average, and again it came back to the moving average. So here I am using the 60 moving average because it works the best for mean reversion strategies. Mean reversion is when you are taking the advantage of the fact that the price is away from its mean, and because it has deviated way too much. So this is how you can use this, what I have just explained, that the price extremes. Okay. The last strategy is basically giving specific signals. Now, let me see how much of the chapter is left. DMI, DX, envelopes, channels, and bands. Okay, alright. So, determining the price extremes is also done. Now, we come to giving specific signals. So, what do you understand by giving specific signals? Some technical analysts use moving averages to give specific signals. These can occur when a price cross a moving average. So this is something which we have anyway already discussed, that when a smaller time moving average crosses a larger time moving average, that generates a buy signal. So like that you can use the moving averages, they might be generating signals for you. And if you have already entered into a trade and you are running at a good profit, the moment you see a smaller time frame moving average crossing a bigger time frame moving average towards the down, that is basically a signal for you to exit the trade, because that basically is showing you a bit of the opposite trend being coming into the picture. So that is also one way how you can be using the moving average. So these were my 4 strategies of using a moving average. Now after watching this video, make sure to go on reading, view and backtest everything which I have taught, and I am ending this video over here. In the next part we will be doing what is direction movement, DMI and everything, and I am going to try my best to make videos as soon as possible. And after that we'll also be starting with the chart patterns. So I'll try my best to cover most of the chapters within the next coming week, so make sure to check the description box below, and you can check out the playlists which are there in the description box below. Also don't forget to subscribe to my channel and click on the bell notification button as well. Thank you.